Welcome back, everyone, to the next exciting bracket of decentralized finance and new financial instruments. With me today is Payne from Blocksize Capital, and he'll have the first, he'll be the first speaker of this bracket. Enjoy. Connor, the stage is yours.
Yeah, thanks for the introduction, Marcel. As he said, I'm Connor. I'm with Blocksize Capital, and today I want to talk about some of the innovations that have been happening in DeFi, but I also want to talk about something that I don't hear talked about frequently enough, in my opinion, and that's how DeFi is bringing in a new age of high-frequency trading. But first, what is DeFi? Well, when we say DeFi, we're talking about decentralized finance, and that is a global open alternative to all of the financial services that you can use today. We're talking about savings, loans, trading, insurance, and even more. But most importantly, it's accessible to anyone, anywhere in the world, with a smartphone and internet connection. Now, this image here, it's really just a small glimpse into the current ecosystem of DeFi. Now, this just goes to show, how over a short period of time, how many new players are entering to build into the DeFi ecosystem. We see stuff like payments, derivatives, stablecoins, insurance, and also prediction markets. Now, DeFi really began to take off in the year 2020, and some of these statistics really lay that out here. For example, we could see that the total value locked in DeFi has increased by 93x since January of 2020 to April of 2021, and that was up to $68 billion. We saw the DeFi user growth increase 2,100%. The market cap of DeFi applications increased 72x in the same time period, up to $123 billion. And there's all sorts of statistics like this that show that DeFi is not just hype, but people are actually getting value out of this, and it's starting to get recognized. Now, more stuff. Now, I've already talked about some of the traditional aspects of finance that is being done with DeFi and being done there, but in order to highlight some of the new innovations, I wanted to ask this question, which is, what if I told you that someone would loan you $1 million? Now, some of you don't even have to imagine this. Maybe you've already experienced this. But what if I told you that you could only use this money for a single transaction? And what if I told you that you had to pay back this $1 million immediately at the end of this transaction? And what if I told you that this offer is available to you today, anyone listening right now, through DeFi? And you can do this through something called a flash loan, which was widely popularized by Aave. Now, how this would work, it's really just 4 simple steps in its most simple form. And keep in mind here that these 4 steps are considered one transaction on a smart contract or a blockchain. So, first step, you have to program this, okay? So this is all done programmatically. You have to know how to code. But first, you take out the flash loan. Second, I say go crazy here, but really, you're just telling the smart contract what you're going to do with this. Now, oftentimes, in most cases, it's used for arbitrage. So you've got 2 decentralized exchanges that offer the same asset but at a different price. So you buy from one, you sell on the other, and you take the profit. So you can pay back the loan, that's step 3, and then you keep the profit. Now, this was something that we couldn't have had before smart contracts came into play. Having a loan with 0 collateral, especially in the millions of dollars. But you might already be wondering this next question, which is, what if I'm unable to pay back the loan? So we're going to walk through this as if it were me. So I pre-program this single transaction, and I take out the flash loan. I go crazy with it because I've got an arbitrage algorithm, which I think is amazing, but it turns out to not be so good. So I can't pay back the loan because I lose the money. Well, what happens? The answer is nothing really. Nothing really happens to the state of Ethereum, and this is just the nature of smart contracts. Smart contracts are built so that it will not succeed unless all of the conditions of the smart contract are met. And one of those conditions is that I have to pay back the loan. So that might be a little bit confusing, but you can think of it more as like a hypothetical loan. So I get a hypothetical loan, and then a check is done. If I were to do everything I want to do, would I be able to pay this back? And if the answer is no, the transaction fails, and nothing has changed on Ethereum. The only thing that happens is that I have to pay a transaction fee for the miner, really, who found out that this transaction would not work. So I want you to keep this in the back of your mind as we move forward. We're going to move on to high-frequency trading. And maybe you've heard of this book, Flash Boys by Michael Lewis. It's best not to get it confused with Flash Loans. This book came out before Flash Loans did, so best to just separate that. But what this book was, it was an expose into what was happening behind the scenes with high-frequency traders in the United States. And the real message that Lewis wanted to get out was that the markets were rigged. So there's three aspects to high-frequency trading. First is that bots are acting on algorithms as opposed to humans who are manually making the trades. Second, there's huge investments into competition to obtain the lowest latency or the fastest speeds to execute. And third is something called latency arbitrage, which we're really going to be calling front-running here. And for those who aren't familiar with the book, it tells the story of someone named Brad Katsuyama who worked for the Royal Bank of Canada. And a typical day for Brad would be that he needs to buy, let's say, 100,000 shares of Microsoft for his client. So he's looking on his screens, on his terminals, and he sees, okay, there's 100,000 shares across 20 different exchanges for 50 cents each. So he would normally press a button to buy it, and everything would work out as planned. However, in 2008, things started acting strange. Now, when Brad would press that button to buy the 100,000 shares, poof, all of those exchanges, or not all of those exchanges, all of those shares would disappear from the market. Now, he would get some of it, but the majority of it was now gone. In fact, he would see it reappear, but now the price was higher. So it's not 50 cents anymore, it's 51 cents. So what was happening there? It was as if there was a ghost in the machine. It was as if someone knew what Brad wanted to do before he actually did it. So he's thinking it's his computer. He's banging the side of his computer. He's calling tech support. But it wasn't until months of investigation that they realized that this was not just a problem for Brad or the Royal Bank of Canada, but this was a system-wide problem. And it was not a ghost in the machine. So what happened here? Normally, Brad at the Royal Bank of Canada, he would execute, he'd press that button to buy the 100,000 shares, and it would go via a cable to the next exchange, BATS. And then it would go to the next exchange and the next exchange, and it would keep picking up shares along the way. Now, in 2008, when things started to behave a little differently, what was happening was that Brad would press that button, it would go to BATS, the closest exchange, where a high-frequency trading firm would pick up that Brad wants to buy Microsoft. And then it would use shorter, faster cables to get to the exchanges before him. And then they would buy up all of the shares, increase the price, and sell it to Brad. So, in other words, someone saw Brad's intent to make a transaction before he ever made it. Now, we see similar things happening in DeFi, although you wouldn't think so. But the same sort of mystery of what happens to your transaction on, say, Ethereum. When you make a transaction, that mystery is very much there. Matt Cutler of Block Native describes Ethereum transactions like checked luggage, because you give your luggage to someone, and they put it onto a conveyor belt. It goes into a dark tunnel, and at the end of your flight, you stand there, anxiously waiting to see if you're going to get your luggage. And if you've ever sent a blockchain transaction, you can probably relate to that feeling. The difference is that there's no central authority that's going to help you find out what's going on with your blockchain transaction. But what really happens behind the scenes? In order to understand that, you have to know what the mempool is. And it's got different names. Sometimes it's the transaction pool or the transaction queue. But you can think of this as a waiting area for transactions before they get accepted onto the blockchain. There's no single or master mempool that exists, but all the nodes have a copy of this. So every transaction has an associated gas fee. And this is the reward for the miners for putting it onto the blockchain. So transactions that have the highest gas fee tend to get mined first. And you can think of this mempool this waiting area for transactions as a glimpse into the future state of the blockchain. And anybody who's tech savvy enough could access this. So in order to explain the simplest version of front running, I want to talk to you about CryptoKitties. Now, you don't need to know much about CryptoKitties. I'll tell you what you need to know. It's basically, with every CryptoKitty has its own unique DNA. It's a game on Ethereum. And you can breed 2 CryptoKitties. And there's a couple of transactions that happen here, but with one of them, anybody could breed the kitty. Anybody could breed this kitty during a certain time frame and earn a reward. So we can look at this person on the left. This person on the left saw a transaction. They saw this transaction to make 0.08 Ether. So they pay a gas fee of 0.001 Ether. And they're excited about this because, I mean, that's a really nice profit. However, that person isn't the only one on the blockchain. Additionally, there's a bot, the little devil guy there. Now, that bot has access to the mempool, and they can see all of the transactions that will be taking place, like we said. So they even see this other person's transaction. So this bot is doing one job. It's going through the mempool, and it is just asking one question for each of these transactions. If I submit this transaction instead of them, will I make money? And if the answer is yes, then they submit the same exact transaction. They copy-paste it, except they submit it with a slightly higher gas fee. And that's what happened in this example. We've got the bot who submitted the same exact transaction, but for a slightly higher gas fee. So theirs was mined first. So in this scenario, the person who did all of the work to find out what CryptoKitties are going to breed, to find out when to breed them, they actually end up getting nothing, while the bot who copied them got the 0.08 Ether reward. In fact, the person who did all of the work, they actually still have to pay a transaction fee, because even failed transactions cost gas. And I don't know if we can consider that as fair. So here's a real example of front-running a decentralized exchange transaction. Now, the sequence of events might be a little confusing here, but the transaction in the middle is a transaction that has been front-run. The bot was looking through the mempool, and they saw this transaction in the middle, and they saw that someone is trying to buy 123,000 of this token, and when they do, the price of that token is going to increase. So they say, okay, I want to buy before they do, and then I'm going to sell immediately after, and that's what they did. And we're going to look at the same transaction, but with a slightly different view. We're going to use a tool called Etherscan. So here we've got the same order of transactions. We've got the innocent person who just wanted to buy some tokens in the middle there. And then we see the bot who said, okay, this transaction is going to increase the cost, probably due to low liquidity. And then, so what they do is they submit the transaction. And I want you to look at those orange boxes. The bot submitted a transaction with slightly more gas than the transaction underneath it. Less than 0.00001 Ether or something like that, just so it could be mined first. And then immediately after it sold, and we can see how much money this bot made. So after transaction fees, it ended up being just about like $5. So it's not a ton of money for this bot, but you can think if this is going on constantly, it really starts to add up. So when we compare traditional high-frequency trading with what we've seen in blockchains and in DeFi, we know that high-frequency traders rely on speed, while blockchains rely on gas. The transaction fee is what matters. So if you have 2 bots that are competing because they both see a transaction that they want to front run, then they compete in what's called a priority gas auction. So it's basically where 2 bots are taking turns increasing their gas fees for their transaction, so that whoever has the highest gas fee when the block is mined, they win this race. So a lot of this research was done from a paper called Flashboys 2.0, which really kicked off this discussion. And they found as of 2019, millions of dollars were made from front running, and that was just on a small subset of smart contracts. And that was before DeFi took off like we saw in 2020. So we can assume it's a lot bigger than what was found in this paper. We have to remember that all transactions go through this mempool, And tech-savvy people have a sneak peek at all of these transactions before their mind. So if someone could build a sophisticated algorithm, then they can profit by strategically generating their own transactions, often at the expense of normal users. So I want to ask you that question again that I asked in the beginning. What would you do if someone owned you $1 million? And if you can only use it for one transaction, we know we're talking about blockchain here now. But now you know what you know in terms of the mempool. You can see the future of what's going to happen. And the question becomes not so much what would you do, but what could you do? And people are getting creative here. They're using flash loans to front-run transactions. There's one example of a more nefarious one where somebody used the combination of front-running and flash loans to basically exploit a smart contract and steal someone's NFT, so they're valuable, they're digital valuable. CryptoPunk, if you know it, which was worth about $70,000. And they did this for free. Now, one of the authors of that research paper, Flash Boys 2.0, is Ari Jules, who would later become the head of research for Chainlink, one of our partners at Blocksize Capital. And they would work on something called this fair sequencing service, where they would use oracles to sort of fix this problem of front-running. Now, this is still in development, but it seems like a promising solution, one of them. Another option is alternative consensus mechanisms, like we see with Solana. What they have is something called proof of history, where every transaction has a timestamp, and that determines the order of these transactions. So now bots and miners can't decide which one's going to go first or last. Now, I don't tell you these things to scare you. DeFi, it's quite incredible. But I just want to remind you that the innovative aspect of decentralized finance is not the finance part. It's the decentralized part. So when you have this new ecosystem of peer-to-peer transactions, we see a lot of things from the traditional finance world being adapted for DeFi, but we also see new things, like flash loans. We see similar behavior that we saw with HFTs, high-frequency traders in the traditional markets, start to take place in DeFi. So there are not only amazing people looking to revolutionize the DeFi space, but there are also people looking to exploit it. And people who are building or interacting with these smart contracts, they should be aware of these aspects because DeFi is here to stay. And if you want to participate, then you should be aware of the ghost in the machine. So, thank you.
Thank you, Connor.
Yeah.
And I think it's amazing how easily you explain complex phenomena so intuitively. I really enjoyed that presentation. We have a question, if you still have time.
Yeah, I'll try my best.
And I think you touched on this in the end of your presentation. How can consumers protect themselves from being front-run by algorithms, for example, once there's no, let's say, global solution to this problem is in place?
Absolutely. So a lot of this actually doesn't fall so much on the responsibility of the typical user, but those building the smart contracts themselves. So this is something that you could think of when someone was making the CryptoKitty breeding smart contract. This is something that should have been considered then and there. So when you're building a smart contract, this is what you have to think about. Is it possible that my users are going to get front run? And so yeah, basically I wouldn't say that this is so much up to the users at this point. In most of the cases, if you're, this is not going to affect the typical user, not in any noticeable way. Like I said, it's typically small profits that are made and typically on lower liquidity pools and decentralized exchanges. So, I mean, I think you're okay for now, but if you're planning on building any applications, consider this.
Okay, thank you. A very, very short question from the audience. What's one project you're really excited about?
It's not even relevant to my talk. You know, what's one? I refuse to answer. I'm not going to pump any any projects right now. But honestly, if we're going to stick on the topic of like flash loans and something called miner extractable value, there's one called Keeper DAO, which is in essence trying to make a white hat solution here, where basically people are trying to use this front running power for good in some sense, or to make it more fair. So I would check that out.
Okay, great. Thank you very much. If you also want to contribute